Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, we have a new year and a new economics explained video debunking. And so this is on a video that he made last year, but my videos take quite a long time to make because I'm a one-man show, and so that's why it's coming out now. And it's the video on inflation, and it's asking the question of how transitory inflation is going. Naturally, his conclusion is that inflation is most likely here to stay, and that's going to be with us for a little while longer, even if he doesn't outright say it. We should show more of his sources so that we know where and how he pulls his claims from, but there you go, there we have it. Anyway, my video is going to show that yes, inflation right now is painful, no one enjoys it. However, even with all of that, the majority of people, they're actually making decisions, and sales data bears this out, whereby they think that inflation will be temporary. And most people believe that inflation is a short-term phenomenon, that once the supply side issue is sorted, and that's what most people believe, or at the very least they're acting as if they believe that once the supply side issues are fixed, then prices will return to normal. And the idea being that the government stimulus and all of the actions being taken by the Fed, those are temporary and will be unwound. And so they're not a permanent fixture of the economy like it was in the 70s and the 80s. And so once we fix the supply side issues and a few other issues in the economy, then things will more or less return to normal. And that is the time when you should go out and start spending again. So I've assembled over 20 sources, and many of them I referenced directly in my video, but you should definitely check them out in the description box down below. But without any further ado, let's get into EE's claims, and I hope you enjoy this soothing B-roll.
Last month, Jerome Powell announced that the Federal Reserve Bank would be moving away from the term transitory inflation. This marked a significant reversal in rhetoric from the newly reappointed Fed chairman, who had been defending the bank's position on quantitative easing for over 18 months at that point. This announcement roughly coincided with news about the highest levels of inflation seen in over 30 years, as well as new plans to cut off the Fed's bond buying program faster than expected, likely in response to these inflation concerns.
Yes, we will get into further details into the inflation episode we're seeing right now. But suffice to say for now that it's very different from the inflation from the 70s and the 80s. The difference between now and what we saw in the 70s and the 80s was that back then people expected prices to continually rise, and so they had to keep buying right now because right now was the cheapest time to buy. Whereas, as we're going to see further on in this video, consumer behavior is very different today. Even though people are complaining, and they are indeed seeing inflation right now, however, predominantly their actions speak to people who think that inflation will indeed be temporary. This is actually borne out by sales data, where nominal spending has actually decreased as prices have risen, indicating that most people right now think that things are too expensive. Moreover, people in general believe that the price rises are temporary and are content to hold off on further purchases until prices begin to normalize because there are better uses for that money. People believe that in the near term that the conditions that led to the high prices will begin to subside, and as a result prices will fall. These might sound like crazy claims, but I assure you that I will back them up further in the video.
Most economic onlookers already knew that heightened inflation was inevitable. You can use all the buzzwords you want, but putting this much money into an economy that is struggling with product availability is going to cause price increases.
Alright, so despite how short this clip from EE is, there is actually quite a lot to unpack, and that's why the following segment is so long. Also, EE later in his video talks about insufficient demand, and that is why I bring it up in this section. So let's get on with it. If this was a simple case of, quote, money printing causing inflation, and we'll get into that too, then inflation should have occurred in 2008 and 2009 with the first QE program. And surely the subsequent QE programs should have led to inflation long before the pandemic struck. From sources 4 and 5, we get 4 main causes for the rise in inflation: spiking price of oil and petrol, the rising prices of new and used cars, and of meat, as the meat packing industry was hit particularly hard by the pandemic. Regarding cars, oil, and meat, from Source 5, we get the following quote: "These components together explain almost 70% of the excessive increase in the CPI." End quote. So, car production is way down, prices are up. Oil production is way down, prices are up. Meat packaging and supply is down, and you guessed it, prices are up. Are these issues of supply insurmountable, or can they be solved? Certainly, we don't know the future, and I wouldn't pretend to. However, if we can think of just one supply story, we can look at the previous spike in lumber prices. Looking at this graph, we can see that the price of lumber per 1,000 board feet just in March and April of 2021 reached a height of $1,500 per 1,000 board feet. However, by July 2021, the price had plummeted to a low of $482 per 1,000 board feet. Yes, the price has since risen to $824 per 1,000 board feet. However, this is still not as high as $928, which is what it reached in July of 2020, where we were at the start of the pandemic. So yes, the pandemic is causing supply disruptions. However, these are not insurmountable. And we can see that the situation can correct itself in a relatively short amount of time. Is that going to happen with cars, oil, and meat? Who knows? But all evidence points to the fact that things are improving and that inflation will fall as a result. Now, naturally, you should not make any serious financial decisions based on my analysis. However, I do feel confident in my predictions based on everything that I'm reading and what I will show in this video. And you can have a look at my sources down in the description box below. However, let's get to what EE said about what people think about inflation. I'm certain we could find surveys where consumers aren't concerned about inflation and ones where they are concerned about inflation and believe that inflation is either here in the medium term or the long term. However, people say one thing and do another all the time. What really matters is how people act in the face of inflation. Is this a situation like the 70s, where people expected inflation to increase in the future and had to buy right now in order not to pay more later? Or is this a situation where people are more chill and think that the current situation is temporary? I will show the evidence for my answer later on. However, EE does like to talk a lot about economists. So, what do they have to say? Here we see the Chicago Booth poll of economists, where the question is: the supply bottlenecks that are currently contributing to rising prices can be reasonably expected to abate without causing inflation over the longer term to be above the Fed's target. And then here we see that the majority of economists agree, whilst some are still uncertain and a few do disagree. And so here we can see that most economists believe that inflation will start falling once the supply issues are sorted out. And then we have question B. The current combination of US fiscal and monetary policy poses a serious risk of prolonged higher inflation. Here we see that the vast majority of economists actually agree that it's a combination of the Fed's actions and the federal government's actions that are contributing to the current inflation that we are seeing. Whilst this might seem to fly in the face of the point I'm trying to make, the point behind this poll is if there is a direct correlation or causation between US fiscal and monetary policy and inflation, as implied by the question and the answers, then we can expect that once the US government winds down the extraordinary fiscal measures that were put in place to help people during the pandemic, and the Fed starts to tighten monetary policy and stops being so accommodative, we can then expect inflation to start falling. As an aside and a quick corollary, we can look at another poll quickly, which says a significant factor behind today's higher US inflation is dominant corporations in uncompetitive markets taking advantage of their market power to raise prices in order to increase their profit margins. And the overwhelming majority of economists disagree with this statement. And so this would seem to affirm the fact that it's a supply issue and the extraordinary accommodative policies put in place by both the Fed and the US government. And then finally, we can see from this article that top economists in Australia see no prolonged high inflation and no rate hike in 2022. This was written in November in 2021. And so from the first paragraph, we get, despite appearances, especially in the United States, the era of high inflation isn't set for a comeback in the view of Australia's leading economists, and most see no need for the Reserve Bank to lift interest rates next year. Okay, so these aren't examples of the thinking of all economists or every major economist, but at least I'm showing some of my sources and where I'm making my claims from. Again, from source 5, we get the following quote. If the prices of just a few specific items had grown at their pre-pandemic pace, instead of jumping by 50% or more, inflation in 2021 would have been remarkably close to the 1995 to 2019 average, end quote. And then we also get, quote, for one thing, the rental cost of housing hasn't yet ticked up in a meaningful way. In fact, most Americans' monthly housing payments are lower than where they would have been in the absence of the pandemic, end quote. So I hope I don't minimize this issue and the pain that inflation is causing. However, I do hope that by showing you my sources, I have put it into perspective, rather than just making the alarmist claims that EE is making in his video. So, EE also claimed that we had a persistent demand issue, whereby the government sending out checks is causing people to go out and spend before prices rise even further. In fact, from the census.gov report, we see that nominal retail spending has in fact actually been essentially flat since March 2021, even as incomes and prices keep rising. This implies that people by and large think that the inflation will be temporary and that buying right now is not a good use of money. So the thinking of most people is, why buy right now if you think inflation will be temporary and that as supply constraints ease, you can buy at a lower price later? If you really believed inflation would be permanent, you would want to be buying right now before the next inevitable price rise. And we would see that aggregate nominal spending would be increasing, not staying flat. Also, the take where EE said, quote, pumping money into the system that is supply constrained, end quote, is an incorrect take. The quantitative easing, or simply loose monetary policy from the Fed, mostly ended up on the balance sheets of the banks. Well, actually, from source 15, we see more technically that it sat with the Treasury's Fed account and then what is called the RRP facility. And so during the QE programs that also happened in 2007 and 2008, and of course now, the amount of reserves ballooned and the broad money supply increased drastically. However, the results of QE didn't go to you or I. The money that goes to the public is fiscal policy or from the government, the stimulus checks and the like. The reason that the Fed does QE through the banks is that this is primarily how it transmits monetary policy, and this is what it is allowed to do. And so the idea is that QE will eventually lead to real world effects to you and I, but it is something that the Fed cannot do directly with you and I, and instead it has to hope that the banks pass on lower rates and ease credit conditions so that more people can borrow money and just create more loans for the economy. And that's ultimately the point of loose monetary policy, is that more people can get loans, whereas previously perhaps they couldn't have. And so as I mentioned, it might be that the Fed wants banks to loosen restrictions with regards to new loans, but ultimately it's up to the banks to transmit this and for people to actually take the offer. And so naturally, if people don't want to take up the banks on the offer of these new cheaper loans, then the Fed's loose monetary policy stance will do very little. And so through its stance on monetary policy, and of course through QE, the Fed has to hope that the banks and the public cooperate, and that we do what they want. Otherwise, the Fed will not have the desired effect. And so, as I always like to point out in my videos, but especially ones where I criticize EE, the story is not so simple. And in fact, the real story of what is going on is much more nuanced and much more interesting.
In the past, I have been pretty critical of some of these policy decisions. At the beginning of this year, I made a video on how reckless money creation could cause inflation in the US. Now, unfortunately, a lot of those predictions came true.
Yeah, but not quite in the way he thinks. He was categorically wrong about many of the causes, and the analysis in this video shows why this matters. Watch my previous video that dismantles his arguments with actual evidence.
Inflation is the increase in the price level of goods and services over time, normally monitored using the Consumer Price Index, a bundle of goods that is more or less indicative of the consumption habits of urban individuals. If the goods in that basket become more scarce because, I don't know, let's say massive global supply chain issues, then there will be less goods to go around. This means that people that really want or need those goods will need to pay more for them to outbid someone who will be forced to go without. This is called cost-push inflation.
It doesn't immediately follow that because people have more money, that they will go out and spend it. The savings rate right now in the US is back to pre-pandemic levels, but it was elevated for a while as people were pessimistic about the economy and the future and wanted to save their money. From source 17, we see a more nuanced take. Quote, "This cumulative consumption shortfall has been worth about $1 trillion since the end of 2020, end quote. EE is implying that the additional spending people are doing now is from a neutral base, and thus constitutes excessive spending, or more technically, heightened aggregate demand. But what we're seeing here is that there was a large dip from January 2020, and in October 2021, spending only returned to what we would expect it to be based on previous trends. So with regards to spending, people are now catching up to what they were trying to do before, but couldn't because they were being very cautious given the nature of the pandemic. So from source 18, we see something else happening. Durable goods have, over the past 25 years, actually experienced deflation of an average 2.5% per year. So durable goods are up 10% recently, with services only up 4%, comparatively speaking. The inflation rate for services has always been positive, with the inflation rate in services happening right now at levels not seen since 2005. But the recent jump isn't that large, and certainly not as dramatic as the rise of the price of durable goods, and almost certainly the prices for services won't rise too much higher. So obviously, for most people, the price rises in durable goods is bad, and no one enjoys that, but most people understand that this will be a high, and that after supply constraints ease, whenever that is, then prices will start dropping and things will start to get to more normal levels. And furthermore, people don't believe that the stimulus from the government and the loose monetary policy by the Fed will be permanent and that they will eventually be unwound. And this is another factor playing into why people think these price rises will be temporary. People do not believe that these will be permanent factors like they did in the 70s and the 80s. Source number 20 provides some perspective here. Here we can see in number 7 of the series, if we take 1993 to be our base year, we compare prices all the way up until 2021. And I won't go over the chart too much, but it is quite eye-opening, especially the rise in the price of motor vehicles. Even though it's quite drastic, you compare it to the long-term trend, and it's only a small blip. I thought I'd put this up just to really hammer the point that I'm trying to make here. But with that graph, we now let EE continue talking.
If more cash is printed, then more people are going to have more disposable income, which they can use to buy these goods. This will give people more financial firepower to pay more for goods and services, and assuming the supply of those goods or services remains the same, their prices will increase.
People are now spending more because they are optimistic about the economy and about the future. They don't feel the need to save or hoard as much cash. This is a different story to people just getting more money and then spending it. Also, the stimulus checks and government support started around March 2020. And according to EE, this is when people should have started spending more. However, as we saw, the exact opposite was the case. The behavioral factors that I've gone through in this video matter much more than the simple story of people just getting more money from the government and then mindlessly spending it on goods and services. From source number 17, we get the following quote. As of November 2021, the total amount spent by employers to pay their workers was about 1% above the pre-pandemic trend, even as the total number of payroll employees was about 5% below trend. The average employed worker is earning much more than before, even after accounting for inflation. Moreover, things are only continuing to improve. End quote. And so what matters are the expectations people have about the future. From source 9, we see that people right now are saying that the present is not a good time to be buying things like large household goods, vehicles, and houses. That's because they think that prices are too high, but that ultimately inflation will recede and prices will drop to more normal levels. That is when people believe is the time to buy.
It might sound shallow and materialistic, but from an economist's point of view, more goods and services make for better living standards, so cost push inflation is a no-no.
Utterly bizarre framing. Most people think that goods and services make for better living standards. It's not just economists who are high atop their tower having these alien thoughts about the economy. People do actually want more stuff and more categories of things to buy. Otherwise, the stuff would not get produced in the first place. As a business, you're not going to do R&D and produce more goods and create more services just for those elite ivory tower economists to consume. Your products are for the general consumer.
Sure, there are some companies, primarily tech and pharmaceutical companies, that have done well for themselves during the pandemic, but other companies have had their entire function basically put on hold. There are therefore two major forces that have been pushing up stock prices. The first is the lack of alternatives. Historically, in uncertain markets like these, investors would move their money into bonds, which pay less but are a lot less risky. The problem is that interest rates are currently so low that for traditional investors, this asset class just won't cut it. This has meant that investors are begrudgingly needing to pay a higher price to buy stock in companies that are in many instances making less profit.
Perhaps there are no alternatives. It is because of the elevated demand for bonds that longer-term rates are lower. From source 19, we see that rates are low precisely because people keep purchasing the bonds, i.e. treasuries, as the price of bonds moves inversely to the interest rate. Rates on longer-term bonds will start rising once people stop buying them. From source number 18, we get the following quote. Future fiscal policy, while still generating deficits, will be far more manageable and modest in size, as seen in the low interest rates on the long-term treasury securities. One interpretation of these low treasury yields is that the bond market anticipates strong demand for government bonds because people and firms, both domestically and internationally, will prefer to hold on to bonds as a form of liquidity rather than spending on goods and services. So the low treasury yields indicate that inflationary pressures will be kept in check. End quote. And so perhaps investors do actually have more options than EE implies, and these investors are choosing to buy bonds, as the bonds are extremely safe and long-term rates are expected to remain low. Looking at the following graph, we can see that rates for 10-year bonds for most of the world's advanced economies have been trending down for quite a long time. It is true, however, that the QE programs have raised the valuations of the stock market. No one is arguing otherwise. Now, you might think this is bad because it doesn't directly affect you and I, but become an investor in the stock market and you certainly will care.
The second factor is the abundance of capital flooding these markets. The Fed has been buying up corporate bonds, which puts money directly into the hands of businesses and their owners. The goal of this bond buying program was to make sure the businesses had enough capital on hand to survive the shutdowns caused by the pandemic, and it did that. But it also put a lot of money into the hands of individuals and organisations that had nothing better to do than to reinvest it. The shopping spree of the wealthy has not been contained just within the stock market either.
Okay, so these takes are getting wilder by the minute. That money that went to businesses also went to, want to take a guess? Drum roll, please. Employees. Yep, the Fed and the government allowed businesses that would otherwise have to let go of employees to maintain their workforce during the downturn. And the idea was that this is a massive shock to the system, and such businesses shouldn't be allowed to go out of business and suddenly let go of all their workers. With all of these stimulative programs and accommodative monetary policy, the idea is that we can sort of keep the businesses on ice, if you will. And then when things start to normalize, the business can just resume doing what it was doing pre pandemic. If you are employed by one of the businesses that got money from the government or had its bonds purchased by the Fed, you are happy as that allowed you to remain in your job while there is a downturn and while your company's revenues and profits are down. Absent the extraordinary measures taken by the government and the Fed, you probably wouldn't have a job. I'd say most people understand this, even if EE doesn't.
With today's interest rates, most families would pay more in rent than they would pay in a mortgage on a house that they own. A stock market at an all-time high could be written off as a bit of investing exuberance fueled by low interest rates. Those investors getting richer doesn't necessarily mean anybody else is getting poorer, but property prices soaring by 20 to 30% in a year is threatening to further widen the massive wealth gap between homeowners and renters.
Yes, but rental returns are down or flat. Not a bad time to be a renter. What matters more than just the raw house prices is the ratio between incomes and house prices. This is actually a good point to end this portion of the video. This last point about incomes and mortgages and rent and all that jazz, I think I'll save that for another video. The topic is a little bit more in depth than I can give justice right here. Okay, so once again, I want to reiterate, I hope that my video doesn't minimize the pain, the very real pain that inflation brings. It is very real and many people are suffering because of it. However, I also hope that I've shown that there's much more nuance and the actual story is much more interesting. And that most people are acting as if this inflation will be temporary. And in the shorter term, or maybe up to the medium term, whatever you calculate that as, whatever measure of time we're using, that prices will return to normal and now simply is not the time to buy. Also, all these extraordinary stimulus measures helped the economy, tided the economy over this massive worldwide disruption, and ultimately will be unwound. And that's the point. That's why people, unlike the 70s and the 80s, right now, people don't think that inflation will be permanent or something in the longer term. And so that's all I wanted to say for this video. Thank you for watching. If you have any questions, don't hesitate to ask below and I'll do my best to answer them. Or at the very least, I'll collect the questions in another video and answer them there. Otherwise, once again, thank you for watching. I hope you subscribe, rate, share, because that helps my channel, helps me grow and obviously reach a larger audience, and hopefully make money one day, because that would also be awesome. Otherwise, see you guys in the next video.